So now when you're sitting with your clients, a lot of the vehicles that we're going to be recommending have different taxable implications. There's pre-tax vehicles like 401ks, they grow tax deferred, they're fully taxable at distribution. There's after-tax vehicles like cash value life insurance or a Roth IRA that are after-tax dollars that grow tax deferred and you can pull the money out tax-free. Clients don't know how a lot of these products work. So what I say to a client when they're talking about their 401k, and I ask them, do you know that your 401k is tax deferred? Are you familiar with what that means? They're always gonna say yes, and whether it is a garbage worker, whether it is an accountant, an engineer, say, well, let me refresh your memory anyway, why tax deferral is important. Now we have this piece right here that shows the importance of compounding interest. This shows a hypothetical 10% or $10,000 pool of money growing at a hypothetical 8% rate of inflation. And I'll show this to my clients. Mr. Client, I want to show you why tax deferral is important. If we took a $10,000 investment today and we waited 30 years, we're going to put it into this investable bucket. We're going to assume an 8% interest rate and that you're at a 31% federal tax bracket. Now what's going to happen if we don't have to pay any taxes on that money? Inside of your 401k, you don't have to pay taxes until the end. So it's going to grow to $100,627. At the end though, we have to pay taxes, so it's only going to be $72,532. What if I had to pay taxes every single year, like a brokerage account? That same $10,000 is only going to grow to $50,124. Less than half of the money. Tax deferral literally has the power to double the velocity of your money, and I'm going to show that again. But when we're talking to our clients about a Roth IRA or a 401k, Mr. Client, would you rather pay taxes on $10,000 today or $100,000 in the future? Would you rather pay taxes on the seed or the harvest? And it's really going to be up to them. And they don't know what's going to be better or what's going to be worse, a 401k or a Roth IRA. Let me show you how the two of those work, Mr. Client, just so you have your own personal knowledge. I'm going to illustrate a 401k for you right here. Let's just assume we're doing $10,000 a year into our 401k. Let's say we do it for 20 years. How much did we put in, Mr. Client? Make them say $200,000, that's right. I'm just going to assume that money tripled over time. That money grew to $600,000. Assuming we're in that 30% tax bracket, I'm going to have to pay $180,000 in distributions on that money. So it's really only going to be $420,000. Let's see if a Roth IRA works better. Let's do the same $10,000 into the Roth IRA. But wait, I have to pay that $30,000 or that 30% in taxes here. That's only $7,000 a year. So over 20 years, I only contributed $140,000 versus that $200,000, much less. We said the same thing, that money tripled. What does $140,000 triple to? $420,000. A 401k and a Roth IRA will work exactly the same if taxes never change. Mr. Client, in the future, do you think you're going to be making more money or less money than you are now? They're usually going to say more. Okay. Do you think as a government, our taxes are going to go up, go down, or stay flat? Every single time they're going to say taxes are going to go up. So why, Mr. Client, are you taking a tax deduction in the lowest tax bracket you're ever going to be in to probably pay taxes on a much larger number and a much higher tax bracket? Mr. Client, I can't predict where taxes are going to go. They probably are going to go up. If they go up, your 401k is the worst vehicle that you could be in. If they go down, that's the best vehicle that you can be in. Again, I can't really predict where they're going to be. I'm saying you should diversify your taxable bracket like you're diversifying your assets. You should do a pre-tax bucket and a tax-free bucket. And let me show you a couple of different ways that we can do that. And you can position a Roth IRA or cash value life insurance at that time. And then when you're talking to clients, you can ask them, this is a whole other topic. There's tax deferral. Here's the rule of 72. You guys get a bonus today. You get two things. Talking to a client, have you ever heard of the rule of 72? It's a way that we can utilize a simple mathematical algorithm to calculate the velocity of your money. Remember when we were talking about tax deferral in the past? If you were to take a rate of return, divide 72 by that rate of return, whatever that number is, is how many years it's going to take that asset to double. So if we were averaging 6%, divide 72 by 6, we get 12. 12 years. Every 12 years at 6%, that asset is going to double. 9%. If we put 9 into 72, that's 8 years. Every 8 years, that asset is going to double. Remember, we were paying about 30% in taxes. So here's the difference between not paying taxes in the future. Let's go 8 years down the road in this example. At 9%, our asset is now $2,000. 12 years down the road, at 6%, we're now $2,000. 16 years down the road, at 9%, we're now at $4,000. 24 years down the road, our 6% asset is at $4,000. Our 9% asset is at $8,000. The exact same story I told you over here, I'm telling you in a different way. Tax deferral can literally double the velocity of your money. That's why it's so important that you do your 401k, that you do a Roth IRA, that you invest in cash value life insurance. But I'm not saying you should do one or the other. I'm saying you should split the difference and we should invest in both taxable buckets.